Hello and welcome to Switzer Super TV. I'm Peter Switzer. This is my colleague Paul Rickard. Hi Paul.
Hi Peter.
So it's been a pretty volatile start to the year, down in January, up in Feb. Tell us what happened.
Well, in February, Peter, the market was up by 4.1%, more than reversing January's losses to be up by 1% for the month on a year-to-date basis. And pretty much an even performance across the sectors. So we saw that those sectors that had done not so well in January did better in February. Year-to-date, utilities at 6.5%, the A-REIT or the property sector at 3.8% are probably leading it on a year-to-date basis. They were some of the laggards in 2013, so the market has recognised that they're a little bit cheaper. But pretty much across the board, all sectors are up, and I think we're starting to see much more focus on some of the individual companies as opposed to the sectors per se.
Yeah, and I've got to say, I've been getting really bullish, but of course there are a few curveballs out there at the moment.
Well, there are, Peter, and you wrote some pretty positive stuff on the weekend, but we've seen sort of Crimea and everyone's getting concerned about that. Look, how big a factor is this type of external event to our market? Yeah,
I got to say, in looking at it, it kind of reminded me of September 11, not anywhere near it, but September 11 was interesting because everyone got scared, the market was closed down, the stocks market fell, but once the dust kind of settled, it rebounded. So I'm figuring that all the good stuff, the improved economic data, the technical analysis, all points to the market going up. This has been like one of those curveballs from left field. It will bring the market down, but I think it probably will create a buying opportunity for those stocks that get sold off by those people who play the short-term market. The long-term players can go in and probably pick up some stocks they really like.
Any other major risk factors as we think about 2014?
I think I'm not worried about too much. I think the economic data is going to improve. I think China will improve in the second half of this year. I think the earnings season is going to be good. It's going to be, in a sense, these left field type factors like the Crimea. Who would have expected Russia to roll into the Crimea? But I still think these things will be overcome. The geopolitical stresses will be overcome, and we'll have a pretty good year this year.
BHP and Rio both reported during the month, and interestingly enough, Charlie Aitken was pretty positive about the BHP result in particular, but he more calls that out in terms of if the market's to get to 6,000, BHP's got to be a pretty big contributor to that.
Yeah.
What's your take on the big miners?
Yeah, I think the big miners are going to do well from the improving global economy, and as I say, I think China will do well as well because China, its best customer is Europe, and Europe is actually getting better. So all up, I think the 6,000 possibility is there. And I think BHP and Rio will help that go along the way to make that particularly important benchmark.
And finally, Peter, a lot of talk still about sector rotation. We looked at those figures to see how it occurred in February, and there really isn't much occurring in terms of market performance.
Yeah.
Where do you sit on the sector rotation school at the moment?
Yeah, well, I think if I had, for example, if I was investing $10,000 every quarter and I've been going yield, as I've been recommending, I'd be inclined maybe to start sneaking maybe 3,000 out of the 10 into the kind of stocks that are going to do really well if the dollar falls to where I want it to go, 80 or 85 or 80. But there's an economist out there saying 66. Adam Boynton from Deutsche Bank. Now, that happened, a lot of those stocks would really rocket along. So I'm going to position myself for those good quality companies that I'm happy to hold anytime, but particularly when the currency's low.
Well, I'm with you. I think there's you've got to look at a lower currency and what that means for certain companies. But I think it's too early to give up on the yield sectors, and I think with interest rates staying low in 2014, they're still going to do okay. They may not lead the market higher, but it's too early to dump them. So I think it's just a question of looking a little bit of orientation towards some of those companies that'll benefit from either because they report in US dollars or their earnings are based offshore.
Absolutely. So that's Switzer Super TV for this week. Thanks for joining us.